To an outsider, the stock market looks chaotic. Red and green lines flash across screens, tickers move at breakneck speed, and millions of dollars change hands every second. It is easy to look at that frenzy and assume you are staring at an exclusive, high-stakes casino built only for financial experts. But if we strip away the glowing screens and the complex financial jargon, we are left with a very straightforward question. When you log into an app and press buy, what exactly is happening to your money? Long before algorithms and mobile apps, the market was a physical room. People gathered in places like this to trade actual paper certificates, representing fractions of ownership in real businesses. Behind all the modern technology, that core function remains the same. The stock market is a practical machine designed to connect everyday people to the financial growth of actual companies. Every ticker symbol on a screen represents a massive physical operation that employs thousands of people and occupies a significant geographical footprint. Domestic giants like Reliance require billions of dollars in upfront capital to expand their networks, build refineries, or launch nationwide telecom grids. To fund that kind of aggressive expansion, companies face a dilemma. Taking out billions in bank loans means taking on massive debt and restrictive interest payments. Instead, the company can invite the public to chip in. They divide their total ownership into tiny, equal pieces called shares, offering these slices to investors at an affordable price. The business secures cash to grow without taking on debt, while everyday consumers become legal, partial owners of the enterprise. So the company gets its cash, but how exactly does holding a digital record of ownership make you wealthy? This chart illustrates the first mechanism, price growth. As a company uses its raised capital to expand its operations and build new infrastructure, the business becomes more valuable, and the price of your individual slice increases. The second mechanism is dividends. Many established companies take a portion of their actual quarterly profits and distribute it straight back to their shareholders in the form of regular cash payments. Your financial return is directly tied to the physical profitability and expansion of a real-world enterprise. If the underlying math of business growth is relatively slow, taking years to build factories and scale revenues, why do stock prices fluctuate every minute? This graph highlights the gap between actual value and daily price. The smooth, slow-moving line represents the true growth of a company over time, while the erratic, jagged line is simply what people are willing to pay for the stock on any given day. Those wild daily swings are driven by noise. A sudden news cycle, a shift in interest rates, or collective investor panic can cause the price to plummet or spike, even if the company's long-term health remains unchanged. These emotional swings introduce real risk. In the short term, losing money is possible if you are forced to sell during a sudden dip. Market volatility is the price of admission. Investing turns into gambling only when you react to those short-term emotional swings, rather than trusting the long-term value of the business. Surviving that daily noise requires a specific strategy. Beginners who succeed follow strict rules to protect their capital. The foundational rule is thinking in years or decades. By expanding your timeline, you can outlast temporary market crashes. Next, you mitigate risk by starting with small amounts of capital, studying a company's financial health before buying, and dividing your money across several different businesses so a single failure doesn't wipe you out. All of this requires psychological discipline. You must resist the urge to buy when a stock is hyped, and suppress the panic to sell when the market inevitably drops. Patience and discipline are the tools that strip away the chaos, turning the stock market into a reliable engine for building wealth. To see where this economic engine operates locally, look at the streets of Mumbai. The Feroz Jijiboi Towers stand as the historic hub of India's market activity. Today, almost all domestic equity transactions happen through two highly regulated institutions, the Bombay Stock Exchange and the modern National Stock Exchange. Digital brokers like Zerodha, Grow, and Upstocks have democratized the process, allowing anyone with a smartphone to securely participate in this system in seconds. The barrier to entry has never been lower. But before you put your money on the line, take the time to learn how these businesses actually operate so you can invest deliberately. When approached with knowledge and the long-term strategy, owning a piece of the world's best companies remains one of the most effective ways to build lasting wealth.